I start off the show every time with a summary of kind of what I saw happening in the stock market. Because as an investor, as you either get ready for retirement or in your retirement, the more you can kind of understand about what's going on with the market, the better you get. Even if you're dealing with an advisor who's helping you with your money, really that advisor's confined by really your feelings about what's happening with the market, right? So the more, that's one of the big things we do here, the more we can get people to kind of understand, the easier it is to help them, get maybe better rates of return as far as that goes. So I'll start off here with just, the old picture of where the market is. This is going back to 2019. And here's our summary. We've got that pandemic we just talked about. So right there at that bottom point is when we started doing these videos. And I think there's 1,500 videos on there on the channel now. But and so we've had this fantastic run up, and then inflation hit. We got a 28% drop. October 13th of 2022, we hit that low point, and really we've been going up ever since. Right, lots of ups and downs, including today.
Yep.
I think it's down about 1.6, 1.7% as the show started here. However, this is coming off of an unbelievable run. Yeah. And I've been saying for quite a while that the market needs to have some rest here because it's really, I think, it's more stressful to me when the market runs without some kind of break. I just feel like, again, I always use this analogy of stretching a rubber band. So when you stretch a rubber band, it stretches pretty easy at first, but the more you pull on it, the harder it gets to stretch even farther. And so it's kind of that stress is almost like what I feel when you see the market going up. I enjoy the run, but I'd rather have some pressure taken off and have that kind of backup. And I think it's interesting. If you look at last year, 24, 25% return, we had a 10% downturn,
Yep.
right? You look at 2020, we had a 9 and a 10% downturn, even though the market was up over 20% that year also. I think it's necessary for a market that's really going to go to have some periods of time where it's coming down because it kind of stimulates this buying opportunity. And so, a couple things going on in the last, because it's not just today that the market's down. This is the last really month. The market's been at least going sideways to down. We have some up days and what have you that kind of make up for some of these down days. But the same picture has been in there all the way through this, and that is that inflation is higher than expected, right? Really, if you look at it, the overall inflation year over year has still been coming down or at least been flat, depending on what measure you look at. So that's good. The Fed still likes that. But what we're seeing is that the month over month inflation for January, February, and March, at least for the CPI so far, has been higher than expected, and annualizing out at around 4%, 4.8%, in that range. And we did get good news yesterday from the PPI. The month over month was only 0.2%, which again annualizes out at 2.4. PPI is the wholesale inflation report. So, that's good. I'd like to see wholesale inflation coming down. Theoretically, it can translate to lower inflation on the consumer side in the end, right? But we'll have to wait for PCE here at the end of the month, which is the favored measure that the Fed looks at. But it's the threat, in my opinion. Everybody was worried last year about recession. I was more worried about increasing inflation, right? And just because the numbers are pretty good, people are out there spending. I think the pandemic and the pent-up demand is really kind of driving things. I saw a really cool headline talking about the 2020s it being the roaring 20s, similar to what we had happen after the last pandemic. So, we have that combination of this artificial intelligence, right, kind of coming up and creating these fantastic profits for some of these companies. We have this pandemic, the pent-up demand, people out traveling, spending money, doing things that they might not normally do because, they were all locked down for a few years or what have you. And, we had falling inflation and the thought process of falling interest rates.
Yep.
And so what's happened now is we're starting to change that thought process. We're saying, okay, maybe inflation isn't going to fall as fast as expected, and maybe the Federal Reserve isn't going to be lowering rates as fast as expected. And so there's this kind of churning in the market because it's already priced in, at the beginning of the year, priced in 6 rate cuts, right? Yeah. And so there's lots of excitement about that because the market loves rate cuts. It just means that businesses can operate, less expensively, right? And so those factors are still playing in. And the factor that's creating the problem isn't artificial intelligence. It isn't the pent-up demand that was driving this. It is the fact that inflation is looking a little bit hotter than it was. The fourth quarter last year, which is where this huge run really got going, I was annualizing out at 1.5% on core PCE, right? And so that was, it was looking really good. And then we've got a difference here. Some of it's maybe seasonal, people doing things at the beginning of the year more than they might at the end. But we'll have to see how that plays out as far as that goes. I want to talk about some other things because we're heading into earnings season, right? And so let's take, this is a great chart that came out of Bloomberg, and this is a comparison of expectations, the red line, for earnings, right? From the analysts, we're always talking about expectations, and then the actual S&P 500 going back to 2012. And you can see there's a fairly good correlation there, right? As the expectations. And so they're saying that, hey, this market's being driven by rising profit estimates. I'll take a challenge on that headline, because if you look real closely at this chart, it's actually the estimates lag. See that? When the market is hitting a low, the estimates haven't hit that low yet, right? When the market is hitting a high, the estimates haven't hit that high yet. The market leads the estimates. Yeah. Right? And so, this is an important point. If you want to become a good investor, in my opinion, pay attention to the movement of the market. It is, it will tell you what's going to be happening in the future. It is a leading indicator. There are 10 leading indicators in the leading indicator index, LEI. One of them is the S&P 500. There are a lot of potential indicators out there. And so the fact that the S&P 500 is in there, I think, is a really important component. And so you want to take a look at the price. And we're heading into earnings season. We had earnings today. Partly the market was coming down because, JP Morgan Chase was, struggling, right? And I was saying that yesterday. I thought the bank earnings probably won't be the thing that really gets things going. But we did see a rally yesterday in the big tech stocks, because that's where I think we're going to see the better earnings come through. The reason that the market leads is because people know what's going on. You can't, there's all these blackout periods around different company earnings reports, but there are tens of thousands of people working in that company, and they can see when it's doing well, they can see when it's doing poorly, and then there is an infrastructure of, of investing companies, hedge funds, mutual funds. There's big money, trillions of dollars in the market, and they're going to spend big money trying to figure out what's going on. So the market's going to move in advance. So this big run that we're having is telling us that things are going to continue to do well. However, you can also get temporary pullbacks on that, right? And so you gotta kind of pull away from the day to day and look at more the long term. So what we look at is what's called a primary trend, right? So when the primary trend is down, we want to be super defensive. When the primary trend is up, we want to be in, right? And maybe we rotate around and we try to capture some of the little minor trends that are happening, but mainly we want to be in. And so one measure of primary trend, and we have a bunch of them actually, is the 50-day moving average above the 200-day moving average, right? So the 50-day in this case is the yellow line, and the 200-day is the blue line. And they actually crossed over February of last year, right? And look at how much higher it is now. Matter of fact,
there's a big stretch there.
Yeah, that's why we're coming down, because of that stretch more than anything. We can attach news. We can attach the situation in Iran and Israel, which is scaring the market right now. Yep. We can attach the fact that that's driving oil prices up. We can attach, inflation being hotter than expected. But really, it doesn't matter. The market was already stretched out. Look at that stretch. I mean, where on that chart since 2019 has the 50-day moving average been that far away from the 200-day moving average? It hasn't. Yeah. And so this is normal. We should have some kind of, pullback. One of the other things we look at in terms of primary trend is, are the lows higher? So every time it sets a new low, is it higher than the previous low? And so you can see the first arrow there was October 13th of 2022. And then we had, three other lows, including the one that ended October 27th on our show back in last year. So very much so, primary uptrend intact, no question whatsoever. And so then we take a look at kind of some of the more minor stretch indicators. So this is RSI, right? So this is relative strength index. This is on a daily basis, and we've presented this before. When it gets above 70, the market's considered stretched out, especially on a short-term basis. This is a 7-day indicator, okay? And so you can see at the end of last year, that big spike there, I think we went to about 81 or something along those lines. We're currently at 45.
Yeah.
Honestly, when I look at this is where I get some more calmness, all right? Yeah, I know the market's down today and all those things, but I'm thinking very strongly that this is what stimulates the buying to get us to the next level. You need to take the pressure off. You need to have that market kind of coming down for whatever reason. I hope the Israel and Iran thing doesn't transpire, honestly. And that's an issue. In the past, these types of conflicts have always had the same pattern. Market drops at the beginning and then starts to ignore it and goes up. I mean, Ukraine's still going on. When Ukraine first started, everybody thought oil was going to go nuts. It did go up to $130 a barrel, came back down to 70 something, right? And so we've got this scenario now where, again, Iran and Israel, and it could always get to be way worse than we're expecting, and so that could affect things. But again, if you look at Afghanistan, you look at Kuwait, you look at what happened in Ukraine, all of these conflicts had the same pattern: drops at the beginning and then goes up after. It just does. So we'll see what happens this time, or if anything happens. I think there's enough fear that the market is not willing to sit through the weekend, and people are taking some of their risk money off the table, which is fine. Whatever it takes, this market needs a break, and I think that break will kind of stimulate. So when somebody comes out with great earnings someplace along in this earnings season, there's some room to go up. And then all of a sudden you got some short covering that comes in, right, in market-wise, and then they're all buying when they're covering their shorts. And this is the anatomy of a kind of another move that's going to happen, because we are still in a primary uptrend. We can have a 10 or 15% drop from here and still be in a primary uptrend, and then eventually, boom, the buyers start coming in. So anyway, that's what's happening this week. I still think this is a fantastic market to be in. It's very sound. Earnings continue to do quite well, in my opinion, especially versus expectations. Expectations continue to rise, and the economy is doing, really, considering that we just raised rates 5.2% or whatever it was in total. Really incredible how well the economy is doing as far as that goes. And inflation's going to be a tough one to get down, especially this last bit to get it down into that range. Yeah, and so it'll be interesting to see how the Fed plays this out and what they do. I've been warning that they might not do a rate cut this year, since really end of January, just because I see some numbers that make me think that there's not a real reason for them to do it. Maybe one or two at the end of the year, but we'll see what happens. So anyway, that's what's happening for this week. Thank you for joining, for the summary. And